But before that, we got to do a little housekeeping. So today's webinar is sponsored by Zoho. I don't know if you're familiar with Zoho, that's awesome. If you're not, go ahead and head over to zoho.com. We have over 50 plus applications that can help with any business needs. And today, the speakers from the Zoho side will be from the Zoho finance partner team. And if you would like to become a partner or learn more about the partnerships or find an accountant, go ahead and head over to zoho.com/CPA. And there you'll be able to find more information and actually speak to one of us to kind of see if you're a good fit for the partnership. And if you have any questions today, let's go ahead and go over what Showtime and the presentation software looks like. If you go ahead and look at the left-hand side, you can see the question section, the chat section. If you would like to go ahead and the chat section is for you to communicate with us, saying if you can't hear us or see anything on the screen. And if you go in there now, you kind of see people telling us where they're from. Like Kimberly said, she's from Florida. And the question section is where you would need to write a question directly to the Zoho team or Avalara. You can ask anything related to Zoho or Avalara, or really any question if you would like, but let's try to keep it towards Zoho or Avalara. And we have someone in here who can help answer any Avalara question. His name's Evan Owens. I'll introduce him here in a second. And we have the Zoho team as well. And this webinar will qualify for 1 CPE credit. In order to receive your CPE credit, you have to attend the entire session, and you need to answer 3 out of the 4 polling questions. And I'm going to go ahead and launch an example of a polling question. This doesn't count towards it, but this is just an example. And I just want to really know how everyone's doing today. If you see it kind of just pops up on your screen, you're able to answer. And I can actually show the results of the answer. So a lot of people, it seems, they need more coffee, which is interesting. So do I, and I just had a full glass. So that's funny. But yeah, and also in order to receive the CPE credit, you have to stay and answer the evaluation at the very end. And anyone who doesn't want to receive, anyone who's here not to receive the CPE, we do appreciate you fill out the evaluation so we can learn what we did wrong and what we did right on these webinars, and it helps us with future webinars. And the last thing I wanted to touch on is this session will be recorded, so don't worry, it'll be sent to you. And that seems to be our number one question in the beginning of the webinar. And so let's introduce the team. First, I'll introduce everyone on the Zoho side, and I'll go ahead and talk about me. My name is Nathan Rogerson. I'm over here on the marketing team at Zoho for the finance apps. And my background is in accounting. I've been doing accounting for over 5 years, and I was an accounting advisor. So I really know this topic is very, it's something that I struggled with whenever I was an accounting advisor, definitely in the early years whenever you don't even understand sales tax. And as I started to get used to it, definitely in Texas, I got a hold of it. But whenever I would deal with companies outside of Texas, it got a little bit more stressful. And I'm really happy to be here for this webinar to learn more about it, and so we can share the word with other businesses out there and accountants. And I wanted to introduce the Zoho team. So Val, can you hear me okay?
Yeah.
Good day, everyone. Background about yourself?
Absolutely. Good day, everyone. Val Steed. I'm a CPA accountant background and very thrilled to be here. Been in the accounting technology industry for about 35 years, so many years involved with many different companies and organizations. Very thrilled to be driving, kind of spearheading a direction toward accountants, bookkeepers, CPAs, CAs, pretty much the whole accounting profession, if you will. And thrilled today, very thrilled to have such a great guest speaker from Avalara, because this is a very important topic today, something I've spoken on for many years. And just thank you for being here. I think you won't regret today. So thank you.
And Tala, can you hear me okay?
Yeah. Can you hear me okay, Nathan?
Yes, Tala, I can hear you.
Fantastic. So good morning, everyone. Thank you so much for joining today's webinar. My name is Tala Bakar. I'm a program manager here for our Zoho Finance Partner Program. I've been at Zoho for almost 5.5 years now. And, for those who have been with us for a while, you've noticed the vast improvement and new applications that we've launched in the last just even 1 or 2 years. And the Avalara integration is a really, really important part of the finance apps. So we're really happy to have Avalara with us today. Just wanted to also reiterate what Nathan mentioned earlier about becoming a Zoho partner. So all of us work on the Zoho partner team. And you're probably wondering why there's so many faces on a single webinar. It's kind of this interesting podcast style we've been doing in the past, where we have a featured speaker who has kind of all of the brains behind the presentation, but we kind of bring the questions. And so we aren't going to be all jumping in at the same time, but just wanted to let you know why we have so many. But thanks so much for joining. And we look forward to seeing you throughout today's session and on future sessions.
Yeah, we try to stay out of each other's hair, but sometimes we're very passionate about what we're talking about. So hopefully today we can keep everything streamlined. And so let's introduce Evan Owens. He's over there on the Avalara team, and he's a strategic alliance manager. And Evan, can you hear me okay?
I can.
Okay, awesome. If you want to just do a quick intro, and then we can get to Scott.
Sure, yeah. So as Nathan mentioned, I'm a strategic alliance manager, which in simplest terms means that I'm responsible for the success of our partnership with Avalara and Zoho, and have been working with Zoho for the last 3 years. So I'm excited to have a chance to share what we do with all of you.
Okay, awesome. Thanks, Evan. And he'll also be over there in the questions panel answering Avalara questions. And so let's go ahead and introduce Scott, who is the presenter of today. And Scott, he has over, years and years, 10 years of just South Dakota sales tax division. And I'm sure he's going to be able to share a lot of information with sales tax. Scott, can you hear me okay?
I can hear you very well. Thank you.
Okay, cool. Could you go ahead and give us a little introduction of yourself?
Sure. Thank you. Appreciate that. We don't have enough time for me to do a good job of introducing myself, but
yeah,
I'll do the short version. I do government relations and tax policy for Avalara. Been here for 7.5 years. Prior to that, I did 7 years as the executive director of a thing called the Streamlined Sales Tax, and that is what is now 20-year-old organization of state government, local government, and the private sector to try to make sales tax simpler and more uniform. The only time in the history of the United States where business and states have sat down, looked at what makes tax complicated, and actually implemented solutions to that. Prior to that, I spent 10 years running the South Dakota sales tax. South Dakota sales tax is the broadest and most inclusive sale. Well, not the broadest. There's 3 states that argue has the broadest sales tax: South Dakota, Hawaii, and New Mexico. And I had the pleasure of doing South Dakota's tax everything. So they tax accountants. If you were a CPA in South Dakota, you'd have a sales tax license, and you'd be collecting sales tax from your clients. If you're a CPA in Florida who has clients in South Dakota, you need to think about the Wayfair decision and see whether or not the Wayfair decision makes you a taxpayer in South Dakota. The folks from accounting today were kind enough to make me one of the top 100 most influential people in 2018 and 19. And I spent a lot of time talking to accountants because that's how we get this old business issue resolved.
Yeah, thank you for that, Scott.
So today we're going to talk about sales tax, obviously, and that's something I've done my entire career, and it was all done by accident. I never went to college for tax. Learned it all on the job. Learned it by making mistakes. Learning by listening to people who did understand it, and tried to get them to make me as educated as they were. We're going to talk about why it matters, why the sales tax is an important thing for state government, local government. Talk about economic nexus. That's a phrase that you need to memorize, economic nexus. Why sales tax are complicated? It's that's a week-long conversation right there. We'll talk about a little bit about consumer use tax, which is another reason why it's complicated, and then talk about how to make this whole process work a little bit better. Why tax compliance matters. It's easy. It's a huge portion of state and local budgets. This slide just talks about state government tax. If we were to have the the effect that sales tax has on local revenue, this would be a much bigger portion of total state and local tax revenue. Nearly 47% of state revenue is from sales tax, and that includes selective sales taxes like the tax you would pay if you registered a car. Nearly every state has a tax on, I think every state has a tax on when you buy a car. It doesn't always work like a sales tax. Sometimes it's collected by the governor directly when you registered it. You go to the county courthouse and you want to drive and you want your license plate. That's when you pay the tax. Some states like Tennessee, where I live, it's collected by the dealer. But this is an important part of state budgets. And it is because of that, they are very serious about implementation and enforcement of that tax. Now, I never use this slide when I'm talking to my friends in state government. They don't think of themselves as needier and greedier. And the pandemic, we could have added needier, greedier, and desperate to that first line there, because today states are quite concerned about how their budgets are going to be impacted by the expenses associated with the pandemic, and then the effect on tax collections because of the pandemic's devastation of our economy. So this is why states care about it. And compliance is not optional. If you listen to a Secretary of Revenue or a Commissioner of Revenue somewhere talk about how he or she manages their sales tax, they talk about a voluntary tax system. There's nothing voluntary about our tax system. It is mandatory. It is a choice that you get to avoid going to jail. So when you hear some tax administrator or some legislator talk about the voluntary tax system we have in the United States, remember, it's voluntary only if you don't want to go to jail. Otherwise, this is an involuntary tax system. Those laws make this an obligation on everybody that is making sales, earning income in the United States. Things in the last 20 years, there has been an explosion of ways the states have come up with to try to get people to collect their sales tax. All this is just on the one side. The other side of the chart is the things that businesses do that creates obligations for them. Add new geographies or products. I'm glad you said that you understood Texas, because if all you understand is Texas, or frankly, or any state, you're going to be shocked when you start to look around what other states do. And geographies means you open a store, you have employees, you have a warehouse, new products. There's a rule in sales tax that all tangible personal property is subject to sales tax unless specifically exempt. But who the heck knows what's specifically exempt? So when you add a new product and it's tangible, it's a cup, it's a glass, it's a book, you kind of have that. So you know in the back of your mind that all tangible personal property is subject to sales tax unless specifically exempt. You have to ask yourself, where in the world am I exempt? You can't answer that question unless you are actively understanding what states are doing and what they have done, and because much of this stuff has been around for a long time. Obviously, the last thing that you want to be a trigger for your tax challenge is a sales tax audit. And I hope that at the end of this presentation, you feel like you're a little bit better prepared for a sales tax audit, because that's really the whole point of understanding tax compliance, is to be able to do it so well that you don't care if you get audited.
Hey, Scott, before we continue, I'm going to go ahead and launch the first poll question.
Excellent.
And just a reminder, if you would like to receive a CPE credit for this webinar, you have to answer 3 out of the 4 polling questions. And kind of, Scott, on that back slide, I think it is interesting. Whenever I was talking to a bunch of small businesses back in the day, it was like a couple years ago. It was just so crazy to see the amount of businesses that weren't handling sales tax properly, and it was really just an eye opener to me that, hey, this is just a business in its own to help businesses with sales tax, because they can do their own accounting, but sometimes they just can't really, grasp the sales tax fully.
Well, and it's unfortunate because the education system we have around the world for accountants is amazing for accounting.
Mm-hmm.
It's hard to find an accounting program in the United States. I can't speak for the rest of the world, but it's really hard to find an accounting program in the United States where they talk about sales tax. Or if you do, it's part of an introductory class on taxation. And
Mm-hmm.
there's it's broken into thirds, and the thirds are the federal income tax, the state income tax, and then other state taxes.
Yeah.
And that other state taxes is immense. It covers the number of types of taxes that exist at the state level vastly exceed the number and type of taxes at the federal level.
Mm-hmm. Definitely. So everyone answered the poll, so you can go ahead and continue.
Thank you very much. Okay. There's another phrase you need to understand, and it's nexus. It's a word. The word nexus means connection. In this situation, it means you have enough of a connection with the state that the state has the right to make you do things. We used to live in a world where that was a physical presence test. 1967, the United States Supreme Court, in a case versus National Belasest versus Illinois, said that Illinois couldn't make National Belasest collect the Illinois use tax because National Belasest wasn't physically present inside of Illinois. And that set this bright line that limited a state's right to tax, and not right, a state's authority to tax someone or impose a tax collection obligation on someone, depended on whether or not that person was physically present inside the state. For 50 years later, all that was accomplished was a 50-year-long fight of the definition of physically present. What does it mean to be physically present? In this little in the gray box there, you see some of the things that occurred in the last 50 years that states and businesses went to court over. Almost every one thing in that slide or in that gray box are one or two and sometimes 20 different court cases where states have tried to say leasing real property is the same thing as owning real property. Having an agent in the state is the same thing as having an employee in the state. Attending a trade show might mean physical presence it always means physical presence, but it might not mean you have a collection obligation because it's a function of what the trade show is. Are you making sales there? Are you actually talking about, your products? Are you talking about science? Are you talking about, did your HR staff attend a trade show on HR in a state? Lots of court cases around the country on whether or not that HR person's attendance at an HR trade show in a state created enough of a connection with that state for that state to be able to tax then the sales that the corporation made. All that changed 2 years ago when the states convinced the Supreme Court to take up again the question of nexus. They did that in a case called South Dakota versus Wayfair. Case decision was issued on June 21st, 2018. The court was looking at a law that South Dakota passed. South Dakota's law said that anybody who made more than $100,000 in gross sales into South Dakota in a calendar year, or more than 200 separate transactions, had to get a license and collect sales tax. So it is it. Literally one long sentence. And the court took this case, and what we discovered after the fact was they didn't really want to rule on the merits of the law that South Dakota passed. They really wanted to get rid of the physical presence test that they created in 1967. They wanted to say, we made a mistake, and they literally did say that. The Belasest decision in 1967 was wrongly decided. They just literally got rid of the physical present restraints that they had imposed upon states. Remember, this was a restraint on states. It was an opportunity for business. Business could conduct any kind of business they wanted to inside of a state and not have to collect sales tax, as long as the activity wasn't physically present inside that state. So the result was an immediate flood of legislation around the country, where other states looked at what South Dakota did and adopted nearly exactly the same law. We would be in a better position today had they adopted exactly the same law, but it's nearly. And so what we have today is this new obligation to collect sales tax based solely on sales. So we used to live in a world where a business could plan what they needed to know about a state sales tax because they planned where they're going to be physically present. You knew you were going to open up a store in a state, and you should have known when you opened a store in the state that was going to create a physical presence and an obligation to collect sales tax. So you got to plan for that. You got to prepare. You got your accounting team got to understand and was given time to understand the sales tax differences between that state and all the other places you did business in. Now we live in a world where your customers decide you're going to collect sales tax. And arguably, it's the very last customer that you have that throws your sales in that state over whatever that state's threshold is. South Dakota's $100,000 in gross sales. So you're selling and you're selling and you're selling in South Dakota, and you don't really care. And then all of a sudden you make a sale to somebody, and that is the sale that puts you over $100,000 in that year in South Dakota. That customer of yours decided what you need to know about South Dakota. That person pushed you over a threshold that now requires you to have a sales tax license and to start collecting sales tax. And before you can do that, you have to understand what makes South Dakota different than Wyoming and what makes Wyoming different from Hawaii. Today, we have 43 states that have adopted this same law, or one nearly like this law. There's a little, we need to do this as a poll question someday. There's 5 states that don't have sales tax: New Hampshire, Oregon, Montana, Alaska, and Delaware. They go by an acronym, and it's called NOMAD. So when you hear the word NOMAD and you're thinking sales tax, and who in the heck would ever think of NOMAD and are thinking about sales tax? But if you hear those two things together, they're talking about New Hampshire, Oregon, Montana, Alaska, and Delaware. You see, we have an asterisk by Alaska, and that's because there's no state sales tax in Alaska, but there's 110 cities and boroughs in Alaska that do have a sales tax. And they formed a remote seller sales tax commission. It's operated by the Alaska Municipal League, of all things. And each of those cities are slowly adopting an ordinance that's exactly like what South Dakota adopted by statute. So these ordinances that are being implemented in Alaska cities and boroughs say that if you make more than $100,000 in sales in Alaska, you have to collect sales tax in the cities that have adopted the ordinance. So we color Alaska blue because they believe they have the authority to do this, and it's just crazy complicated. 2 states with a sales tax that haven't done this are Missouri and Florida. They have their own individual reasons why they haven't done it yet, but they talk about it all the time. So I said that these states nearly adopted the South Dakota law. Well, there's some differences in what they adopted that's really critical. One is they don't all have the same dollar threshold. It's $500,000 in California and Texas. It's $250,000 in Alabama, $250,000 in Connecticut. But in Connecticut, you have to have 200 sales. So it's $250,000 in sales and 200 retail transactions. Whereas in Alabama, it's just $250,000 in sales. North Dakota, it's $100,000 in sales. The rest of the country is pretty much what South Dakota did: $100,000 in sales and 200 separate transactions. A separate transaction is an invoice. Doesn't make any difference if the invoice is for $1 or $1 million, or whether it's for one product or 1 million products. An invoice is a transaction. You'll see that we have Kansas highlighted here. Kansas has taken a very aggressive, in some people's minds, radical approach to this concept of a threshold. They have one at all. So in Kansas, the rule, and this was done by rule. This is not done by the legislature, because the legislature and the governor can't agree on what to do. But the governor has some authority, so the governor did what she thought she had the right to do. Their rule is, if you make a sale in Kansas, you have an obligation to collect sales tax. And they make no apology for saying, if California wants to have $500,000, that's their choice. We in Kansas don't have one. So if you make a sale in Kansas, you have to collect our sales tax. And they just sent a press release out a couple of weeks ago talking about all the money they're collecting with their economic nexus threshold obligation on retailers around the country. So remember this slide, because this is one reason why sales tax is complicated, the different thresholds in the states. And there's more to this slide than I have time to talk about today. Let's talk about some of the other things that make sales tax complicated. What are your challenges? What are your clients' challenges? Unable to keep up with the many tax laws and jurisdictions. 45 states in the District of Columbia and Puerto Rico, plus the cities and boroughs in Alaska, have a sales tax. In addition, there's about 12,000 or so local governments in the United States that have a sales tax. Now, the good news is the majority of those, the administration is done by the state. So when South Dakota has 270 cities with a sales tax, you file one return. You don't have to file 270 returns. Now, what makes it complicated is the difference in the way they're imposed. It's really easy to have incorrect tax calculations in a state like South Dakota because the local taxes are cities, and city boundaries change. Not only that, the historical tool used by businesses to manage the tax rate has been a zip code. And if you're old enough, you and most of you probably aren't, you remember that 9-digit zip code is a relatively new thing. For the longest time, we had 5-digit zip codes, and that's all there was. Then the post office created a 9-digit zip code solely to help them manage the mail more efficiently. They didn't create it for sales tax purposes. They didn't create the 5-digit zip code for sales tax purposes. State of South Dakota, 270 cities with a sales tax. There are 2 5-digit zip codes that are wholly inside a city limits in South Dakota. So if you use a 5-digit zip code, or your clients do, to collect sales tax, you've got almost no chance of being right, except in the rare instance when the customer is in one of those 2 5-digit zip codes that's wholly inside a city limits in South Dakota. Otherwise, I lived in Pierre, South Dakota for a long time, which is the state capital. It's right on the Missouri River, right smack dab in the middle of the state, 13,000 people. Because the Missouri River is right there, and there's another city on the other side, the zip code, the 5-digit zip code, stops at the river. Now, there's a semicircle of addresses where that 5-digit zip code is used by the post office to deliver mail. Many of them are outside the city limits of Pierre. So if you're relying on a 5-digit zip code to collect sales tax in Pierre, South Dakota, you've got like a 45% chance of being wrong, because you're going to charge city sales tax to somebody who lives outside the city but has a Pierre, South Dakota address with a Pierre, South Dakota 5-digit zip code. Managed exempt certificates. If you make lots of sales, and all of these things are immensely more complicated today because of the Wayfair decision. All these things have always existed. There's not a thing on here that wasn't there before the Wayfair decision. All these things are everybody's problem now because of the Wayfair decision. Because customers drive where somebody has to understand sales tax. All of the complexity that exists in the state and local sales tax system in the United States is open for everybody. We all now have to know the 5-digit zip code boundary in Pierre, South Dakota. Just a little slide to give you some frightening concepts. 152 million mailing addresses in the United States. I said 12,000 jurisdictions. A lot of those the rules are the same inside the local government as they are inside the state, but not always. And you have to know what that difference is. Tens of thousands of rates. That's really where the big difference is. 270 cities in South Dakota with sales tax. Almost all of them have a 2% sales tax rate, but they don't all have a 2% sales tax rate. 131,000 fuel tax scenarios. Most of us don't spend any time in the fuel tax business. It is unbelievably complicated. Millions of products and service exemptions. The previous slide, we talked about how managed and exempt certificates is a cost driver. It is an immense cost driver because, in the old days, in the physical presence days, that was one of the things you had to know when you open a store. Now, with Wayfair, wherever you make a sale and where that marginal sale is that puts you over threshold, that's when you have to care about exemptions. You don't care if your customers are exempt if you're not collecting sales tax. Who cares? When you have to collect sales tax, you then have to care when your customer's exempt. You have to care when the product's exempt. You have to care if they've given you the right piece of paper that you use to defend yourself in case of an audit. There's another thing that you absolutely have to remember. Customers never get audited. Sellers get audited. 100% of the liability that's associated with sales tax errors is on the seller in this country.
Hey, Scott, before we continue, I'm going to launch the second poll question. And that would be very interesting if the government would go after the customer for sure. I think that
Just a comment too, folks. Excuse me, Nathan, and jump in and remind everyone, please put your questions in the question area and not in the chat area. That allows us to track it and also put multiple answers. And just please do that. Thank you.
But yeah, so it looks like almost everyone's answered, but yeah, you honestly are making this somewhat terrifying in some situations if you are selling products and you're in multiple states and everything, for sure.
It is a very good business to be in. If you're helping people with their sales tax.
For sure, Scott.
These things change all the time. I mean, this is an example. This is the slide that we use when we teach new employees at Avalara.
Mm-hmm.
We try to, especially the salespeople. We said, okay, you're talking to somebody who thinks they got a sales tax problem. Maybe I do, maybe I don't. Well, you just ask him. Do you make sales in Colorado? Yeah, we do. So these two addresses are a block apart from each other. They both have the same 5-digit zip code, and the sales tax result couldn't be further apart. It's just an amazing, and Colorado is a in many ways a classic example of complexity, but Kansas and Missouri and Texas are all equally as complicated, and there isn't any real way of knowing how to do this if you don't have this kind of a map. Okay.
There was a question, Scott, on Florida, and I'm not seeing any thresholds on Florida. Are you familiar with Florida and what they're doing on the thresholds? I'm looking back at a Cherry Beckert site that I posted, and I don't see Florida thresholds.
You have to remember the map of the states that have done this. Florida hasn't done this. So there is no threshold. So there's no threshold in Kansas, Missouri, and Florida.
So we have no idea. We pretty much got to be collecting sales tax.
No,
and everything.
No. I'm sorry. Let me finish here. So Kansas, there's no threshold because they just don't care. But you have to collect there. In Missouri and Florida, they don't have a threshold because they never passed this law. So there is no sales tax collection obligation in Missouri and Florida for remote sellers. In those two states, you have to be physically present. So
physical Nexus rules apply.
Oh yes, they apply. And there's an important thing to remember when you're thinking about the difference between physical presence and economic presence. Remember, economic presence is driven by your customers, and it's all sales. Physical presence is driven by you. You've done something inside that state that gives them the authority to impose a collection obligation on you. Well,
and this new economic nexus does not replace physical nexus. You can
no,
have both.
you can have both. That's right. They kind of overlay on top of each other.
That's right. That's right.
The thing to remember about physical presence is the very first sale that you make once you create a physical presence is when you should have collected sales tax. So if you have a salesperson that's in Florida and you're not collecting sales tax, salespeople are physical presence. The state, if they find that salesperson, they find that you have physical presence, they can make you go back to the day that salesperson entered the state. And this could be years, and make you pay all that sales tax that you should have collected from your customers. So physical presence it's absolutely critical people understand where they're physically present, because those are the sales where there's a serious look back, and it's a very financial burden look back. Under economic nexus, when there's a threshold, you're going along and you're making sales, and you, as long as you haven't exceeded a state's economic nexus threshold, you don't have a collection obligation. It's only after you've exceeded the threshold that you have a collection obligation. And the sales that you made that got you to the threshold, those don't count. So you, as long as you're always under a state's economic nexus threshold, and remember they vary, none of the sales you make in the state are the kind of sales that they can audit you for and make you pay the tax on. Okay, so some of the things that make sales tax complicated, other than all the things we talked about before, is obviously the nature of things. Are you a contractor that's selling and installing? Are you a retailer that sells a warranty along with the thing that you sold? Pardon me. Most states tax warranties. Some states don't tax warranties. If the warranty is taxable, then the products that go into fulfilling the warranty aren't taxable. What if you bought the warranty in Tennessee, the repair was done in Kansas? All those things make this process immensely complicated. Exemption certificates. So Kentucky has 17 different exemption certificates. Every time the legislature creates an exemption, the Kentucky Department of Finance creates an exemption certificate. And it is their expectation that when the seller makes a sale to someone who's claiming they're exempt because of this new law the legislature passed, that seller have that new exemption certificate. And it can be very costly to not have an exemption. I take it back. It's always costly not to have an exemption certificate, because there's we talk about having a sales and use tax audit. When states talk about, if you get a notice of intent to audit from a state and they're going to talk to you about sales and use tax, when they're talking about sales, they're talking about your exempt sales. They're going to look at your tax sales just long enough to know that you know what sales tax rate to charge. They're going to go into great depth and great detail on the sales you didn't charge sales tax on. Those are the sales where historically they know people make mistakes. And they're going to want to see all your exemption certificates. They're going to check to see whether or not those exemption certificates are still valid. And valid can mean lots of different things. Valid can mean it is exactly correct. Sometimes they say, okay, you're right. You got 90% of the right information. We're good. We'll move on. Almost always in an audit, they give you time to get the exempt certificate. It is hard to get exemption certificates for sales, exempt sales you made 3 years ago, to somebody whose business doesn't exist anymore. These are real-time decisions you have to make. You've got a customer that wants to buy what you're selling. They tell you they're exempt from sales tax, and you want that sale. They don't want to give you a certificate because they don't have one. I'll get you. Don't worry. I've got one. I'm going to put it in the mail tomorrow. You'll get it. And you make that sale and you forget the fact that they told you they were going to put it in the mail. And the auditor comes in 3 years from now and you think, oh, that's right. Joe was going to give me that exempt certificate. I better call Joe. Well, Joe got rich and moved to France. Joe doesn't care that you got audited. That exempt certificate doesn't exist, and the state's going to make you pay that tax.
Yeah, Scott, it's like chasing down a 1099.
Oh, yeah, it's exactly like 1099.
Yeah.
You know, the people die, and you don't get 1099s from the dead, and you don't get exempt certificates from the dead.
Mm-hmm.
That's why it's critical to get these things at the time of sale.
Mm-hmm.
Have a process in place that allows you to collect those things. I know that. So I told you the sales tax side of a sales and use tax audit. Well, the use tax side is where the real money is. You know, when a state calls you and tells you they want to audit you, they're going to look at three things. They're going to look at your sales, and they're going to divide them between taxable and exempt. They're going to spend all their time on the exempt. Then they're going to look at your purchase invoice. They want to know what you've bought because they know that you're likely to have bought something from someone who wasn't licensed and didn't charge you sales tax. The consumer use tax is the tax that exists in every state that has a sales tax. The difference is that the sales tax is imposed upon the seller. The use tax is imposed upon the buyer. So when someone doesn't charge you sales tax for something that a business input, something that you've bought that you need to operate your business, you have a legal obligation to calculate that tax and send it to the state. It's a self-reported tax. Well, the states know people don't do that. And this is where all the money comes in from a sales and use tax audit. They look at your purchase invoices. They look to see whether or not, they divide them between the ones that were tax charged and divide them that weren't, where there was no tax charge. They'll look at the ones where the tax was charged to make sure that person was licensed, the seller was licensed. Once they figured out that person was actually licensed, then they're done with that one. They spend all their time on the ones where there was no tax charge. Very much like the sales tax side of it. They spend all their time looking at the sales you didn't charge sales tax on. They spend all their time on the use tax looking at the purchases that you made where you weren't charged sales tax. And they will just keep a running list of the amount, and they will add those all up. They'll multiply that times the use tax rate, which is always the same as sales tax, and they'll send you a bill for that tax. Today, they're also,
I got one for you. I
Sure.
really think we ought to talk about this drop ship issue.
Oh.
Jeffrey DePoint asked, why do some of my vendors charge sales tax when drop shipping to my customers, even though I do not meet the Nexus rules for that state? Isn't it wrong because they are charging tax on my purchase price and not on my sales price?
The answer to that question was in the question.
Right.
I didn't meet the economic nexus threshold. So there's 7 states out there, and California is the most aggressive, but there's 7 states out there that say if the drop ship company is physically present inside the state. Now, this may change with economic nexus. I'm guessing.
Nexus too, right?
Yeah. So what they're saying is because the drop ship company has a requirement, it has nexus with the state. They're going to make that person the tax collector if the retailer isn't. Now, in theory, if I were a drop shipper, no. So here's the bad news. The way to avoid having the drop shipper charge you sales tax is to get a license in those states, collect the sales tax, and then you'll be able to give that drop shipper a legitimate resale certificate. So the only way to avoid that is to pick up the work yourself. Now that because of economic nexus, that whole dynamic is changing. And so it's really easy for a drop shipper today to say, well, if you don't want me to charge a sales tax, get a license. If you exceed the threshold, you probably have to have a license anyway. So yeah, no, this is an historical tool used by states to get some sales tax on every transaction to the extent they could lay their hands on somebody. So use tax is that thing that you owe. We've talked about why auditors love use tax. It's easy money. I did a survey 5 years ago. 80% of the tax collected in the sales and use tax audit came from use tax. Now, Wayfair is changing all that because, in theory, Wayfair has created more tax collectors. So there should be less use tax that's owed because there's more people collecting sales tax. The challenge for buyers is these folks that are now collecting sales tax may not have any idea what they're doing. They're charging you sales tax on stuff that isn't taxable. They're ignoring the resale certificates you've sent them. They're ignoring the exemption certificates you've sent them. They aren't charging you your sales tax. They're charging you their sales tax. So the Wayfair decision, in theory, eliminates some of the burden on buyers to pay use tax, but at the same time increase the burden on buyers to manage the right tax that they get charged. This is just a little chart that we put together to scare people.
Hey, Scott, I'm going to go ahead and launch the third poll question.
Please do. Thank you.
Yeah, sorry. And you can continue.
Okay. I was going to look for questions there. So, how do you make this easier? It's hard to make it easy. These are the things you have to do to collect sales tax. You have to determine where you have a nexus. Where am I physically present? Where do I have economic nexus? You have to register. Sometimes it's very easy. There's the organization that I used to work for, the Streamlined Sales Tax. They've got a registration system that allows you to register in 24 states at one time. It takes 5 minutes to be registered for sales tax purposes in 24 states. The rest of the country, it's a little bit more complicated. You have to know what rate to charge, which means you have to know what jurisdiction your customer's in, and you have to know what the jurisdiction boundaries are, and you have to know whether or not that state taxes what you are selling, which means you have to know the difference between a product and a service. You have to know what each state's definition of the difference between product and service. You have to track and manage your sales tax. And then you have to file a return and make a payment, which these days, of course, is all electronic. No one wants paper these days, and it's very frustrating. So obviously we can help with that. We're in this business. All the things that I've talked about and frankly a lot more are built into AvaTax. They're all there for the purpose of allowing you to automate your sales tax collection or non-sales tax collection when it comes to managing your exempt certificates. All these things it's physically possible today to outsource them, frankly. This is all relatively new. All of the last 20 years has the concept of outsourcing your sales tax compliance caught up to the old concept of outsourcing your payroll. ADP's existed for a long time, and businesses have long outsourced their payroll compliance to a third party. Just in the last few years has that same concept applied to sales tax. And this is just a little chart that we use to explain the 5 things I said you need to be able to do. First of all, you have to figure out how you're going to manage your exemptions. It can be very complicated because one of the complexities I didn't talk about on that picture of the map that had the thresholds, they don't all use the same starting point. They don't all use, some of them it's gross sales, some of it's taxable sales, some of it's retail sales, some of it's gross sales less resale. So there's a lot of places in this country today where a business has to have a sales tax license because that state uses gross sales, regardless of the little taxable sales that company has. So you can have $5,000 worth of taxable sales into South Dakota that you have to have a license for and collect sales tax on if you make $105,000 in sales into South Dakota. You can have $100,000 that are exempt sales, 5,000 are taxable. You have to have a license and manage the 5%. That's 5,000. But you still have to be able to manage and prove to the state when they audit you why the first 100,000 weren't taxable. You have to do a tax calculation. That's all about rates and boundaries and returns. there's, I didn't spend much time talking about how complicated Colorado is, other than the map I showed you. But there are 70 cities in Colorado that administer their own sales tax. They each have their own return. They each have their own method of payment, and they each have their own tax rules. The same thing applies in Louisiana and Alabama, and certainly the same in Alaska. It can be very complicated. And if you're someone who's physically present in every home rule jurisdiction in Colorado, you could file 71 different sales tax returns every month. And all this needs to be done in less than a second, because this stuff doesn't fit inside modern retailing if it can't all those things happen in less than a second. And I don't want to say it's easy, because it's not easy, but it is physically possible to do. And all the things, you have someone who comes in and wants to buy something from you, and it goes all through the process, and you get to the right answer every time. So let's go to questions.
So Scott, if you go ahead and click on that question section, you can see the questions.
Thank you.
Evan, there's one for you on pricing there per transaction. Want to check on that one?
I'll jump on that one. I'm just typing out another response now, so I'll go to that one next. I'm responding to the one about well, it looks like you already answered it. Does collecting a tax from every customer without considering rules of physical presence or threshold, is that legal? I guess since we're talking about it, I'll just say that's not recommended. For one thing, you just raised your prices close to 10%, and also customers will revolt and insist on being repaid for that. But I guess the other caveat to that is, if you do collect money that was not needed to be collected, by all means, please don't keep it. Make sure it gets remitted, because if you keep it, you've broken the law. So
right.
Anyway, Scott, if you wanted to add anything to that.
No, you answered that right. So let me tell you, Nebraska. In Nebraska, it's a felony to collect sales tax without a sales tax license.
Yeah. You got to have a sales tax license, right? Follow the state rules, right?
Yep.
Hey Scott, just one thing. If you'd like to show the attendees one of the questions from the question panel, you can project next to it, and it'll pop up for everybody.
Oh, really?
Now, volunteer seller, let me put that site up. Hold on. Or Scott, you might want to put that site up. And by the way, SST, Streamlined Sales Tax Organization, is still out there. And a real important thing, part of what they do, is the volunteer seller option, which, if you're worried about all this, you can go in and, volunteer seller in those sites as well.
So let me.
Did you
no, I'm
mention
sorry.
CSP, Scott?
No, I didn't, but I'm going to do that right now.
Yeah,
so thank
absolutely
you.
Do that.
And Trish, I'll get to your question here in just as soon as I'm done with the streamlined sales tax. So the streamlined sales tax was created to make things simpler and more uniform. And, they did a lot of really good things, but not every state's a member. So what might be uniform and simple is only uniform and simple in, 23, 24 states. It's not simple in all 45 states. It's not uniform in all 45 states. So there's still the rest of the country out there that creates, additional complexity. So we realized early on, I was one of the people that started it. We realized right off the bat that it was impossible to completely eliminate all the things a retailer has to know and all the things a retailer has to do. So what we did was we came up with this idea called a certified service provider. Our goal was to completely outsource sales tax compliance, or to give retailers the ability to outsource. And it's a public-private partnership. And the private part of it is that it's companies like Avalara that are doing the actual work. The public side of it is two things. The one is the states certify the accuracy of our answers. They look at the tax answers that Avalara gives to its customers and tells us before the answer is given what we need to do to make that sure it's the right answer. So using a certified service provider, the tax answer you get should be exactly the same answer the state would give you if you'd asked them. The second thing that the states do in the public side of this partnership is they pay for it.
Yeah.
So what they do is, and we just signed a new contract with SST, starts on January 1. We're now in our seventh. This is a seventh contract that Avalara's had with the Streamlined Sales Tax Governing Board, and what it does is those states, those 24 states that are a member of that, will pay Avalara to provide this service to a retailer if the retailer meets the definition of a volunteer. And volunteer is less than $50,000 in payroll or property in the state. So if all you do in the state is make sales, you have no payroll, you have no property, you're the perfect person for the Certified Service Provider program. So I want to talk about Trisha's question here for a second. I said that if you have physical presence somewhere, or you have economic presence somewhere, and you haven't got a license and started collecting sales tax yet, you need to have a long conversation with your CPA about how to do this in a way that minimizes your past exposure. All the states in the country have a thing called a voluntary disclosure process, VDA, voluntary disclosure. Pardon me. And what it is it's a way for your CPA to represent you anonymously in front of a state. So your CPA fills out this form, describes the type of business you're in, and all the things that a state would need to know to feel comfortable that they're giving the right answer. And what they'll do, if they agree to it, and the states have to agree to this, the states will say, okay, I know you've been doing business in the state for 11 years. We're going to limit the look back to 3 years. We're going to waive the penalty, and we're going to cap the interest at 8% or 12%. It's a really important process that your CPA can help you with that gets you to a spot where you can, with a straight face, go to your boss and say, okay, we should have been collecting sales tax in this state. We didn't. And we're going to if they find us, they're going to make us pay sales back to the beginning of time plus penalty and interest. If we do this VDA, we can limit our look back, and we can maybe eliminate the penalty and limit the amount of interest that we're charged. It's a really important thing to do, but it's the kind of thing you want to have professional advice for, because these things vary a little bit state to state, and you have to really make sure you got your I's crossed and your T's crossed and your I's dotted.
Hey, Scott, I'm going to go ahead and launch the fourth polling question.
Yep.
Which this one, we're just asking if you would like a free economic nexus consultation from Avalara. And kind of on the same note of what he was saying, and it's just very important, if you don't fully understand, to have someone kind of guide you or just help you, point you in the right direction for sure. And also, I wanted to mention that if you missed a polling question, you can click on the polls tab and answer any questions you missed.
So I want to answer Ed's question here. How does taxation apply when you have a business registered in a tax-exempt state like Delaware and a physical business located in a tax state? Where you're located is irrelevant.
Right.
Both under physical presence and economic presence. Legally, the states can require a seller located in Belarus to collect their sales tax. Now, practically, it's hard for a state to enforce its tax law in a foreign country. But legally, they have the right to do this. And so obviously, if you're being located in a state that doesn't have a sales tax, helps you not at all when it comes to your collection obligation in a state where you've created a physical presence or in a state where you have economic presence. And this is one of the, frankly, the states that live in the nomad states, the states that have the sales tax, they're almost always perfect candidates for the CSP business. They're not physically present anywhere. So they're perfect to go to the SST states and say, hey, I'm going to start collecting your sales tax, but I don't want to pay for it.
Is there any other questions you see in there, Scott, that you could answer? Because
I'm going to
right close on time, guys.
Yep, I'm going to do this one right here. So remember, these thresholds are state specific, and they are literally thresholds. So they're like, I think you're stepping over a door. You're not in the house until you've stepped over the door. So when you go over the threshold, that's when your rules change. That's when you have an obligation. So you make $99,000 in sales into South Dakota in 2019. You don't collect sales tax in 2020. You make $99,000 in sales in South Dakota in 2020. You don't collect sales tax in 2021, unless sometime in 2021 you go over $100,000 in sales. And once you've done that, then your obligation to collect sales tax starts. Now, if we're talking, remember, physical presence is different. If you have physical presence, you have to collect sales tax on the very first sale you make once you've created physical presence.
Yeah. Well, thank you, Scott, for kind of going through all this sales tax information. And I know for me personally, it helped me out a lot, and it helped me understand that I didn't know as much as I thought I knew. And if you would like to be contacted by Avalara directly, here's Evan Owen's contact information. He'll be able to help you out and connect you with the right people out there. And also, I wanted to point out that Avalara provided us some helpful handouts. If you go in there, you'll see that there's a 2020 mid-year sales tax changes form, and there's also a brochure kind of explaining a little bit more about Avalara. There's a few other handouts. There's their website and also the Zoho partner link as well. And I just wanted some closing message. If you would like to receive the CPE, stay till the end. Don't close out of the webinar. I'm going to end the session, and then you can answer the evaluation then. And then from there, you'll receive your CPE later today or tomorrow. And Scott, I really appreciate everything you've done today. It's been great. It's been a great webinar, and I'm sure it helped out a lot of people and pointed them in the right direction.
Well, thank you very much. We value our relationship with Zoho, and we really thank you for this opportunity.
Mm-hmm. It was really great. And Val, do you have any closing messages?
Just a comment that this is recorded. You're going to get a link to the materials and the recording. And I posted a few times out there the economic nexus rules from a little tiny URL that we created years ago. So, and it's current. Cherry Beckert keeps it current. So that's a nice little listing too. So thank you for being here, and take this very seriously, folks. Each state, and even there's multiple agencies within each state, you've got to look into this. This is a nightmare waiting to happen for you. Thank you.
All right. Thank you, everyone.
Thanks, everyone.
Have a good day.